Hi, Anthony Alfo here. Just wanted to send a quick video about tax planning and what are some of the benefits of a Roth conversion, what it is, how it works, and is that something that you should consider? So first off, a Roth conversion is basically just taking money from your traditional IRA, moving it over to your Roth IRA, and paying the taxes on it at this time. It can be smart sometimes to pay taxes now at a lower rate instead of paying taxes later at a higher rate. So let's talk a little bit about how it would work and when you should maybe consider. First off, on the screen we have what the tax brackets currently are. And to understand it, you have to go through each tax bracket progressively until you get to the next tax bracket. So, for example, if you made $80,250 that year, you would be in the 12% bracket. If you made $80,251, you would now be in the 22% bracket. That does not mean that all your money is taxed at the 22% bracket. It just means the last dollar that you made is taxed at 22%. Effectively, your average tax rate would be somewhere around 12% because you have to take the first 20,000 being taxed at about 10 and the other 60,000 being taxed at 12 and then that $1 at 22% to come up with your average tax return. So when we're looking at whether or not a Roth conversion makes sense, we want to look at what your current tax bracket is, what bucket that you're actually in. Have you used up all that tax bucket? And we want to look at to see if you are going to be in a higher tax bracket in the future. If you are, it may make sense to fill up the current tax bucket that you're in, or even one more tax bucket should you be jumping up multiple tax brackets in the future. And that would be the process that you would typically go through to figure out if a Roth conversion made any sense for you. So let's talk a little bit about what that process entails. Essentially, what we're doing is we're going to take money from your IRA today and move it over to your Roth IRA via what's called a Roth conversion. And typically, the best way to pay the taxes on that Roth conversion would be to utilize dollars that you're not actually getting that much of a return on, such as your savings account or a money market. So why are some of the reasons that you might be in a higher tax bracket in the future? Well, number one, if tax laws change, they change from time to time. For example, if you look at the column over here, this will highlight the current tax laws as they are today. You can see what those different tax brackets are percentage wise, and the brackets or the bands in width that accommodate what the lower and upper echelon of that tax bucket would be. And what you can also see on the left side is what it's expected to go and sunset in the future. So today's current tax law is expected to sunset at the end of 2025 and revert back to the old law. And you can see how those percentages are a little bit higher and those tax brackets are a little bit narrower. Now, keep in mind as a caveat, tax laws could change before 2025 and become lower, higher, or even stay the same. So this is something that we can't necessarily control. Another reason why your tax rate might be higher in the future is that you might lose deductions. So for example, when we're younger, a lot of us are financing a home and a lot of people try to pay off their home by retirement, say for example, and if we do pay that off, we're going to lose the mortgage interest that we typically would claim and deduct off of our tax return. Another deduction that we all typically utilize are retirement plan contributions. And so when you get to, say, retirement, no longer having that 10, 20, or 40 or so $1,000 that you're putting into those types of plans, you no longer have that to write off of your tax return. People tend to be a little bit more charitably inclined while they're working and have maybe a little bit more income. Generally speaking, people become a little less charitably inclined when they get into retirement, living off more of a fixed budget or lower type of income. And lastly, when our kids grow up, we can no longer claim them as dependents and obtain those tax credits. So those are some of the reasons why you might lose some deductions in the future, pushing you potentially into a higher tax bracket. Next, another reason that I think is on the minds of a lot of people is our current U.S. debt. It's around $30 trillion today. And at some point, most of us fear that Congress is going to have to deal with that at some point. And one of the ways that they can certainly deal with it is raising tax rates in the future, generating additional tax revenue to pay down that U.S. debt that we currently have. That's something that we should all kind of keep in mind as we are getting further into the future and as that debt continues to rise. Next, something to think about from a historic standpoint, if you look at this, you can see that some of the highest tax rates were much higher in the past, and that we are today collectively actually overall in a lower tax situation. And so perhaps history could repeat itself and we could be in a higher tax bracket in the future. From a planning risk management standpoint, something to think about would also be being in a higher tax bracket due to loss of a spouse. So if you're married, you're currently probably filing what's called married filing jointly. And if you were to lose your spouse, you would then go from that type of tax claiming status to a single taxpayer claiming status. And you can see from this chart, if you had $100,000 of ordinary income, whether that's via pension, Social Security, required minimum distributions, if that was giving you about $100,000, you would be in the 22% bracket if you were married. However, if you were to lose a spouse, maintain that same type of income, you would go from the 22% bracket to the 24% bracket. So that's something from a risk management standpoint that you would want to look at to see if does that make sense to start doing some Roth conversions to protect against something like that. The way that we would figure out if it makes sense to do a Roth conversion is that you would take your current tax situation and you would map out some of the future potential tax situations that you would be in the future by looking at potential future income changes. Some of those changes we just talked about, such as tax law changes, retiring from work, potentially losing a spouse, loss of deductions, starting your pension and Social Security, and when required minimum distributions happen. And looking at on this graph here, you can see that a person, 55 is at a current tax rate, and you can see over time that it's projected for them to go higher at different points in the future due to different future income changes that are happening. And so in this person's case, it might actually make sense to start doing some Roth conversions today. Now, that doesn't always happen. That's not always the case. But the only way to really figure out is go through that type of analysis to figure out if it makes sense and what your future tax liabilities are looking at in the future. Some of the reasons we just talked about regarding performing a Roth conversion wasn't an exhaustive list, but it did serve to talk about some of the good majority. Let's talk about some of the reasons why you might not convert. Some of the reasons why you might not convert is that you will be in a lower tax bracket in the future. If you're going to be in a lower tax bracket in the future, it may not make any sense to do any Roth conversion at this time. If you're somebody who cannot stomach paying taxes now, that's not necessarily due, that might not be a good fit for you. If you don't think taxes will rise in the future, or if you don't have money to pay for that Roth conversion right now in a savings or money market type of account, that might not make any sense either to perform a Roth conversion. And lastly, if you're actually planning to spend from your IRA to live out of it in the near future, it wouldn't probably make that much sense to perform a Roth conversion. So I hope this video was helpful to at least go over the concept of a Roth conversion, why it could make sense, why it may not make sense. Again, if you're going to perform it, you want to be mindful of a specific dollar amount. This is not to say that you're just going to take your entire IRA nest egg and convert it overnight. You want to be mindful of those tax brackets. So to really figure this out, you want to go through an analysis So if you have any questions or you'd like us to perform an analysis for you, feel free to reach out. I look forward to helping you. Thanks again for listening. Have a great day.